Welcome to the deep dive. Today we're diving into the world of mutual funds.
Oh, yeah.
We're going to be looking at what they are, the different types we have here in the UK,
Okay.
and how to navigate all those fees and returns and all that.
Right.
So think of this as like your shortcut to making informed investment decisions.
I like it.
We're using a chapter from Keith Redhead's personal finance book as our guide.
Okay.
So
Sounds good.
let's jump right in.
Yeah, that's a great choice. I mean, mutual funds have become like a staple for so many investors,
Yeah.
but they can be a little mysterious at
Right,
first.
exactly. So before we get into like the really specific stuff,
Yeah.
can you just give us the big picture?
Sure.
Like, why would someone choose a mutual fund
Oh, okay.
over just buying individual stocks themselves?
Well, imagine trying to build a diverse portfolio
Yeah,
with like limited funds.
right.
It can be pretty challenging.
Oh, yeah, for sure.
Mutual funds kind of solve this by pooling money
Okay.
from lots of different investors to buy a whole range of assets,
Gotcha.
things like stocks and bonds.
So you're not putting all your eggs in one basket.
Exactly. You get instant diversification
Okay.
and professional management, even if you don't have a ton of money to invest.
So it's kind of like having a financial advisor,
Yeah,
but without the price tag.
that's a great way to put it.
Yeah.
And, there's two main ways that you can see your return on your investment.
Okay.
Dividends, which are like payouts from a company's profits,
Right, right.
and capital appreciation, which is where your investment grows in value as the underlying assets increase in value.
Okay, so potential for growth.
Yeah.
And a little bit of income on the side.
Exactly.
Not bad. Now, in the UK, we have different types of mutual funds, right?
We do.
Keith Redhead's chapter
Yeah.
focuses on unit trusts, investment trusts, and OEICs. Are these just different names for the same thing, or?
Not quite.
Okay.
Think of it this way.
Okay.
Unit trusts and OEICs are like the reliable cars of the investment world, offering, that diversification,
Right.
professional management.
Okay.
They're generally considered a bit more stable.
Gotcha.
Investment trusts, on the other hand,
Yeah.
more like the sports cars.
Okay.
They can potentially accelerate faster
Uh-huh.
thanks to something called gearing.
Ooh.
But that also means they can be a bit riskier.
Okay, gearing.
Yeah,
That sounds intriguing and maybe a little intimidating.
it can be.
What exactly is that?
Well, imagine gearing is like a turbocharger for your investments.
Okay.
It allows investment trusts to borrow money
Okay.
to kind of amplify their returns.
Oh, wow.
Think of it like using a lever to lift a heavy object.
Okay.
You can move more with less effort.
I'm with you.
Yeah.
So more potential for growth,
Yeah,
but also more risk if things go south.
exactly. Gearing magnifies both gains and losses,
Okay.
making it a bit of a double-edged sword.
Right. So you really got to know what you're doing.
Yeah. Assess your risk tolerance
Okay.
before you go diving into heavily geared funds.
All right. So gearing's a key difference then.
It is.
What other factors set these three types apart?
Another key difference is how they're structured and priced. Unit trusts are managed by a trustee,
Okay.
typically a bank,
Right.
who safeguards investors' interests.
Mm-hmm.
They are priced with a bid-offer spread, meaning the buying and selling prices differ slightly.
Okay.
OEICs are similar in structure to unit trusts,
Mm-hmm.
but offer more flexibility
Okay.
and have a single, more transparent price.
Gotcha. And investment trusts, how do they fit into all of this?
Investment trusts are set up as companies
Okay.
listed on the stock exchange.
Right.
Their price is determined by supply and demand,
Okay.
which can lead to them trading at a discount or a premium
Okay.
to their net asset value, or NAV.
NAV. Okay. We need to break that down because that sounds like a pretty important concept.
Yeah, it is.
I've heard that thrown around a lot.
Think of NAV as the true worth of an investment trust's portfolio. It's like taking an inventory of all the assets the trust owns,
Right.
adding up their current market value,
Right.
and dividing by the number of shares.
Okay.
Simple.
So if a trust's share price is lower than its NAV, you're essentially getting a bargain.
You got it. You're buying the underlying assets at a discount.
Oh, wow.
Conversely, if the share price is higher than the NAV, you're paying a premium.
Right.
Keith Redhead uses the example of Acme Investment Trust to illustrate this.
Okay.
Let's say Acme has $100 million worth of assets
Okay.
spread across 200 companies
Okay.
and 50 million shares available.
Gotcha.
If the current share price is 160p
Mm-hmm.
and we calculate the NAV, it comes out to 200p per share.
So in that case, you'd be buying Acme's assets at a 20% discount.
Yeah.
It seems like a pretty good deal.
It can be.
But before we get too excited about discounts,
Yeah.
I know we need to talk about the dreaded F word.
Oh, no.
Yeah.
Fees, everyone's favorite topic.
Yeah.
Not really, but important nonetheless.
Absolutely.
Fees are like the hidden cost of investing. They could really chip away at your returns over time.
Right.
So it's crucial to understand what you're paying for and how those costs can impact your gains.
Yeah, it's not as simple as just looking at the potential return then, is it?
No.
You really have to factor in the fees to see what you're actually making.
Absolutely.
Yeah.
Mutual funds, they're not free to operate.
Right.
You're paying for professional management, you're paying for diversification, administration research,
Right.
and even marketing costs.
Okay.
All of these expenses are covered through various fees.
Gotcha. So what kind of fees should we be looking out for?
Well, you might encounter initial charges
Okay.
when you first buy into a fund. Think of it as an entry fee
Right.
to join the investment party.
Yeah. Okay.
And then there are annual management charges,
Okay.
which are typically a percentage of your investment that's deducted regularly
Right.
to cover the ongoing cost of managing the fund.
So it's like a subscription fee for having your money professionally managed.
Pretty much. And then
Yeah.
finally,
Yeah.
there are things like transaction costs,
Okay.
like brokerage fees.
Right.
These occur when the fund manager buys or sells securities within the portfolio.
Okay.
If the fund has a high turnover rate,
Mm-hmm.
meaning the manager's frequently trading,
Yeah.
these costs can really add up.
Oh, wow. So how do we make sure we're not losing like a huge chunk of our returns to these fees?
That's the question, isn't it?
Are there ways to minimize these costs?
One way is to look for funds with lower expense ratios.
Okay.
That means they have lower overall fees compared to the size of the fund.
Okay.
Another option is to consider index funds,
Mm-hmm.
also known as tracker funds.
Okay. I've heard of index funds,
Yeah,
but I'm not entirely sure how they work.
sure.
Could you shed some light on those for us?
Index funds are designed to mirror the performance of a specific market index,
Okay.
like the FTSE 100, for example.
Mm-hmm.
Instead of trying to beat the market by picking individual stocks, they simply aim to match its returns.
So it's like going with the flow of the market
That's a good way to put it.
rather than trying to outsmart it.
Yeah, because index funds don't require like a whole team of analysts actively picking stocks.
Right.
Their management fees are significantly lower.
Okay.
Plus, they offer built-in diversification since they track a basket of securities,
Right.
and there's less risk associated with relying on a manager's stock-picking abilities.
So it sounds like index funds might be a good option for investors who want a more hands-off approach.
They can be.
But are they really as effective as the actively managed funds?
Well, studies have actually shown that over the long term,
Yeah.
index funds often outperform actively managed funds
Really?
after you factor in fees.
Wow.
Yeah. And that's because actively managed funds don't always live up to their promise of beating the market.
Right. So the idea that you need like a star fund manager
Right.
to make a lot of money is maybe a little bit of a myth.
It's important to be realistic about expectations.
Yeah.
Some actively managed funds may outperform the market for a while,
Yeah.
but consistent long-term outperformance
Yeah.
is pretty rare.
That's a good point.
Yeah.
I like that. So stay grounded, basically.
Exactly.
Keith Redhead actually has a really good example
He does.
of how fees can impact returns over time, doesn't he?
He does. He presents a scenario where an investor puts £1,000 into a mutual fund
Right.
and tracks its growth over time.
Yeah.
What's striking is that even a small difference in the fee structure
Right.
can lead to big variations in the final value of the investment.
Wow.
This really highlights why scrutinizing those fees is absolutely crucial.
Yeah. I really appreciate these real world examples. It kind of brings the concept to life.
Yeah.
It makes the impact more tangible.
For sure.
Now let's move on to another essential factor.
Okay.
Taxes. I know they can be a bit of a headache,
Oh, yeah.
but we can't exactly ignore them, can we?
Definitely not.
Yeah.
Taxes can make a huge difference in your final investment returns. However, the good news is that in the UK,
Okay.
there are ways to mitigate that tax bite.
Okay. I'm all ears.
When it comes to mutual funds, one of the most popular strategies is to utilize ISAs,
Okay.
or individual savings accounts.
Right.
These accounts allow your investments to grow tax-free.
So it's like a protective bubble
Exactly.
for your investments.
Keeping those pesky tax collectors away.
Yeah, keep them away from my money.
ISAs come in different flavors, including cash ISAs for savings in stocks and shares ISAs,
Okay.
which are perfect for holding mutual funds.
Gotcha. The UK also has other tax advantage schemes
It does.
designed to encourage investment in specific areas. Interesting. Are there any specific schemes that you'd highlight?
Venture capital trusts, or VCTs,
Okay.
and enterprise investment schemes, or EIS,
Okay.
offer tax breaks for investors who are willing to put their money into higher risk, potentially high growth companies,
Gotcha.
usually smaller businesses.
Right.
These schemes not only provide potential tax benefits for the investor, but also help stimulate economic growth.
So it sounds like a win-win situation.
Yeah,
Investors get a potential tax advantage and the economy gets a boost.
it can be.
Now, before we move on, I'd like to touch on one more strategy that Keith Redhead mentions,
Okay.
pound cost averaging.
Mhm.
What exactly is that, and how does it fit into the mutual fund puzzle?
Pound cost averaging. Yeah, it sounds a little technical, but it's actually pretty straightforward.
Okay, good.
Imagine you want to invest in a mutual fund,
Right.
right?
Yeah,
But you're a little worried about market volatility.
makes sense.
So instead of investing a lump sum all at once,
Right.
which could be risky if the market takes a downturn,
Yeah.
you spread your investment out over time.
Okay.
You invest a fixed amount at regular intervals,
Okay.
regardless of whether the market's up or down.
So it's like a disciplined savings plan
Exactly.
for your investments.
Think of it as taking the emotion out of investing.
Okay.
By investing consistently, you're essentially averaging out your purchase price over time. If the market dips, you're buying more units or shares at a lower price.
Right.
If the market rises, you're buying fewer units at a higher price.
That makes sense. Yeah, it seems like a good way to kind of mitigate that risk of investing at the wrong time.
It can be.
But are there any downsides to this approach?
Well, the potential downside is that if the market just consistently rises
Yeah.
during the period you're investing,
Right.
you might miss out on some gains by not investing that lump sum up front.
Okay.
However, for many investors,
Yeah.
particularly those with a long-term horizon,
Mm-hmm.
the peace of mind and reduced risk that pound cost averaging provides
Right.
outweighs that potential downside.
Yeah, for sure. It just seems like a good strategy, especially for somebody new to investing
Yeah.
who might be a little hesitant to jump in with a large amount.
It's a good way to dip your toes in.
Exactly. Now, before we wrap up our mutual fund deep dive, I want to touch on something that's always kind of fascinated me.
Okay.
The whole idea of mutual fund performance. Is it really possible to consistently beat the market?
That is the million-dollar question.
Right.
There's this common perception that actively managed funds
Yeah.
with their expert analysts and all these sophisticated algorithms
Right.
are the key to getting those superior returns.
Okay.
But the reality is a bit more nuanced.
Okay. I'm sensing a dose of reality coming.
Well, a lot of research suggests that actively managed funds on average
Yeah.
don't actually outperform the market over the long run,
Really?
especially after you account for those fees.
So all that effort to pick the winning stocks
Right.
might not actually pay off in the end.
Not necessarily.
Hmm.
There's also an element of luck involved in fund performance.
Oh, really?
Some funds might outperform for a period
Yeah.
simply because they happen to be invested in the right sectors or companies at the right time.
Wow. So being in the right place at the right time.
Sometimes it's just that simple.
Wow. Okay. So past performance isn't always a reliable indicator then.
Not always, no.
Oh, that's a good point. I guess we shouldn't get too caught up in chasing those star performers.
Exactly. It's
Yeah.
also important to be aware of something called survivorship bias.
Okay.
Funds that perform poorly often get closed or merged with other funds.
Right.
So when you look at historical data, the worst performing funds might be missing,
Oh.
which can skew the performance figures.
It's like judging a talent show based only on the finalists.
Exactly.
Without considering all the people that were eliminated.
You got it.
You're only seeing the best of the best.
Right.
Not the full picture.
It highlights the importance of thinking critically.
Yes.
When you're evaluating that fund performance data,
Right.
don't just rely on the headlines
Yeah.
or marketing materials.
Don't believe the hype.
Dig a little deeper.
Exactly.
Look at the long-term track record. Consider the fees.
Yeah.
And be wary of funds that seem too good to be true.
This is why I love the deep dive.
Me too.
It's all about unpacking those complexities and getting to the heart of the matter.
Absolutely.
Now, as we wrap up this episode,
Yeah.
what final words of wisdom would you offer to our listeners
Okay.
as they navigate this world of mutual funds?
I think the key takeaway is to be an informed investor.
Okay.
Don't be afraid to ask questions. Do your research.
Yeah.
Understand the risks and potential rewards involved. Remember, investing is a marathon, not a sprint.
Right.
Choose investments that align with your financial goals,
Okay.
your risk tolerance, and your time horizon.
Right.
And remember, diversification is key.
Yes.
Don't put all your eggs in one basket.
Great advice. Knowledge truly is power, and this deep dive has definitely equipped us with a wealth of information to make more informed decisions.
I hope so.
Thank you so much for joining us.
That was my pleasure.
And as always, keep exploring, keep learning, and keep diving deep.